Hey, my name's James Nicholson and welcome to my YouTube channel. In this video, I want to tell you about a lender that will lend you 7 times your earnings. They'll lend it to you for 40 years and this could help people borrow significantly more money. Now, I'm going to share with you exactly how this mortgage works, who it's from, and I want to hear your opinion in the comments. Do you think this is good to get people on the property ladder that are maybe priced out right now? Or do you think this is reckless lending and going to cause these people to struggle to keep up with their monthly payments? Do comment below with your thoughts and opinions once you've heard a little bit more, at least, about the data and how it all works. Now, I'm James Nicholson, and this property channel is all about house prices, interest rates, mortgage rates, and property investing. Do take a moment to subscribe to the channel over there and hit that bell notification. We're on the way to 41,000 subscribers. You'll see around here somewhere how close we are. And let's get some views on this video. How do we do that, you ask? Simple. Smash like, tickle like, do something to the like button. That helps with the YouTube algorithm and really helps the channel grow. So I appreciate everyone that takes a minute to do that. So what's going on? Well, this is a new type of lending, and I think you're going to see a lot more deals like this in future. You see, mortgage companies are going to adapt. The government has actually encouraged them to almost deregulate themselves a little bit to lend more money, which is not really normally what you would hear from a government, but that has happened in recent months. And so, look, banks they weren't strict at all prior to 2008. Maybe you had a mortgage then. I had multiple mortgages then in my property portfolio. And I recall that you could have a mortgage called a self-cert mortgage. You literally went to your broker and wrote down what your salary was, and then you borrowed as much money as you could. And they didn't really check. It was crazy. And that contributed to the 2008 crash. It wasn't the only reason, but it was one of the reasons. And so then lending got quite strict. Maybe you've tried to get a mortgage recently. It is difficult sometimes. They do check certain things. I mean, I've had mortgages declined in the last year, and then a different lender was totally fine with it. So some lenders are really fussy, some are not. And you've got to really understand what's going on in the market. Now, this mortgage is with a company. The company name, this isn't the month that they are doing this or when they're based. They're called April Mortgages. They've been going about a year. So not massively long, but that doesn't matter to you. If they're going to lend you the money, who cares how long they've been going? But look, they are a new lender and they want to lend you up to 7 times your salary. 7 times your salary. Now, what do you get at the moment? A lot of lenders on residential mortgages will lend you 4 times. Some do 4.5, and there's a small amount of lenders that do 5. There's not many lenders that do 7 times your salary. I think there's one other, and I can't even recall what their name is. If you know, comment below and help everyone else out. But April have decided that, look, a lot of people can afford to keep up the payments because they're already paying a much higher rent. And that's what we're talking about here. There are loads of people that want to be a first-time buyer, but they can't because they're just not passing the affordability check. So April are looking to make that easier. Now, there's quite a few things you need to know about this mortgage. One, your minimum salary needs to be 50 grand, right? That's a minimum. Now, that could be a combined salary with 2 people. So 25, 25, 30, 20, doesn't matter what the mix-up is on that. So a lot of couples would have a combined salary, especially if they're in the southeast. And if you are in the southeast, for example, right now, if you were a couple and you earned 60 grand between you both, and you got the 4.5 times borrowing, you'd only be able to afford £270,000. Now that doesn't get you much in the southeast. In Dorking, you can barely get a flat for that kind of money. If you get closer to London, you're unlikely to be able to afford a flat. But with this, if you had a £60,000 combined salary, you could borrow 420k borrowing. Now, that suddenly opens up a hell of a lot more properties too. If you buy in the right area, you could find a cheap house, but you could definitely afford a flat in most areas. So this gets some people that couldn't get onto the property ladder onto the property ladder. And I think that if they manage their money, then that's a good thing. But I also think if they don't manage their money and they're not good with money, or they've got a unsafe job, this could be a disaster. So you've got to weigh up the pros and cons on that. That's why I want to know what you think about this as well. Now, the mortgages are long. To get the maximum borrowing, you need to borrow for 10 years plus. So it's a 10-year plus deal. The term of the mortgage is 40 years rather than 25. So what that does is that's why your monthly payments are going to become lower. So you're going to have a bigger debt. You're going to be paying less of that debt off each year, which means you're going to pay way more in debt and interest payments over that 40-year period. But it's 10 years minimum. Now, here's some things that you need to also know about that. There is no repayment charges if you want to clear the balance. So let's say you came into some inheritance, you won the lottery, you sold a business, or you're just good at saving and you wanted to pay your debt down, you can pay that off and there's no early redemption charges at any point in that 10-year period. That's good. And you don't get many mortgages that have that. Trackers have that, but not many others. Here's where that is important to understand though. If you move to another lender, that doesn't count in that scenario, and you would pay the normal penalties that you would look at paying with other lenders. So what kind of rates can you expect? Well, the rate on this deal isn't too bad. It's 4.4%, which isn't too bad. Now, this could be something to come back to. This lender, maybe you see this video in 3 months, 4 months, 6 months, 10 months from now, when the mortgage rates have dropped. If mortgage rates suddenly crash because the economy is going through a recession and this suddenly drops to 2%, suddenly fixing for 10 years at 2% is a good deal. And it's something that I would consider doing in that scenario. So that's important to understand. What deposit do you need? They'll give you 85% loan to value as well. So you need a 15% deposit. That's not too bad. That's affordable for a lot of people. So that gets a lot more people into the box on this. What other things do we need to know? The next thing is, another thing here is that you can overpay, right? So you can overpay by as much as you want. A lot of mortgages will only let you pay 10% down each year, but these guys will let you pay any amount you want, overpay. Now, if you overpay them, you can then move onto a different rate with them as well. You can contact them because you'll drop into a different loan to value at that stage, and you can look at refixing on a different lower rate with them if they have that at that time. Obviously, rates could go through the roof if inflation goes out of control, but this is something that some people should and could consider. Two things: if you're doing it with a partner, you need to make sure that relationship's good because you're tied into this deal for 10 years. And if you split up, probably a bit of a messy type of mortgage to get. You need to make sure that you've got a good job and you're confident you're not going to get made redundant. That's important as well. You'd go for a broker on this so they work through all your own personal financial circumstances. I think that's very, very important on this. But would I have considered this mortgage? I started property in 1999. I was 18 years old when I bought my first studio flat. If this had allowed me to go, instead of buying a studio flat, to a 1-bedroom flat, I'd have done that. I'd 100% would have taken that deal, and that would have worked for me because I could manage my money and I knew what I was doing. But not everyone is the same as that. I've got friends and family that are horrendous with money, and I would tell them to avoid this type of mortgage like the plague. Remember, you can borrow 85%, you can overpay as much as you can. So if you get bonuses in your job, you can do that to reduce the term, but it could get you started on that mortgage ladder and get out of rent. Let me know, what do you think though? This isn't for everyone, I 100% agree on that. But what do you think about this type of mortgage? It's a 40-year mortgage, 7 times your earnings. These are going to become more common, I promise you that. Do make sure you like the video. Go and check out the fundamentals of property investing and learn how to find properties below market value, how to refurbish them, how to then pick a high cash flow strategy. It's less than 30 quid. It's a one-time payment. Thousands of you have grabbed it now, so do grab that in the description below and check out all the other content as well on the channel, including this video right here.